Broadcom jumped 1.3%. Moat scores 76. High durability. Two proprietary silicon switches sit in every hyperscaler rack, cementing billions in recurring contracts and locking out rivals. That hardware anchor drives a durability rating of 76 out of 100, far above peers. Stay tuned as the lab dissects how those anchors lock up the cloud forever. What operating evidence matters most for Broadcom Incorporated? Broadcom's structural moat rests on two unmatched hardware anchors deep inside hyperscaler data centers. And another question, what could weaken Broadcom Incorporated's moat durability? First is its dominance in custom XPU design partnerships, where deep co-packaged silicon integration locks hyperscalers into multi-year architectural commitments. Walk the AI stack, and Broadcom sits as a Tier 1 bottleneck, controlling custom AI ASIC, XPU, plus data center networking silicon. The moat here is design partnership, and it should hold for long. AI semiconductor demand remains elevated, but macroeconomic volatility, high valuations, and fears of a broader tech sector correction are driving sharp stock price and target resets. The one force that could crack it: hyperscaler in-house ASIC teams expanding, Marvel direct competition. Broadcom is trading up 1.3% at $421.47. But the market is locked in an intense debate following its recent earnings report. That minor miss broke Wall Street's expectations, marking a 0-for-4-quarter beat streak despite maintaining a massive revenue base. Investors are paying a premium trailing P/E of 70.4x because they are pricing in an aggressive rotation toward artificial intelligence hardware infrastructure. The options market is currently pricing in a plus or minus 1.9% move with a bullish put-to-call ratio of 0.57. Wall Street is looking directly past the slight EPS miss, treating the recent pullback as a temporary pause in a massive long-term multi-year build-out. Capital is actively consolidating into Broadcom, betting that its critical position in custom computing chips and data center networking will far outweigh short-term earnings volatility. The engineering reality that decides whether Broadcom's valuation is justified comes down to custom ASIC, design integration, and silicon packaging throughput. Broadcom's custom AI accelerators rely on TSMC's 3nm N3E process node, combined with advanced CoWoS packaging. To evaluate whether guidance can support a 70.4x multiple, look directly at networking throughput specs. By comparison, Marvel's competing Teralynx switch architecture requires multi-chiplet packaging to approach comparable throughput, incurring higher interconnect latency and driving up total rack power consumption beyond 100 kilowatts. Broadcom's physical design advantage enables 76.3% gross margins, confirming that its hardware performance justifies its forward guidance revisions despite the recent EPS miss. Quarterly financials showing modest revenue momentum for Broadcom. High capital costs act as a relentless physical tax on technology infrastructure. Yet Broadcom is turning macroeconomic friction into pure competitive velocity. With the 10-year Treasury yield, Broadcom's top-line revenue growth of 47.9% and EPS growth of 85.4% demonstrate that monetary tightness is actively pushing cloud giants into Broadcom's design pipeline. On the policy and regulatory front, shifting trade directives and mounting tariff proposals threaten to disrupt international hardware supply chains. When trade policies elevate the imported cost of finished server racks, hyperscalers aggressively strip out third-party component markups. They bypass transactional hardware vendors and partner directly with Broadcom to co-design proprietary chips, insulating their long-term infrastructure budgets against regulatory turbulence. By embedding its intellectual property directly into hyperscaler custom silicon programs, Broadcom ensures that even if federal monetary policy remains restrictive, enterprise capital expenditure flows straight through its custom design gate. High interest rates eliminate speculative hardware bets, forcing capital into proven, highly efficient infrastructure where Broadcom holds absolute structural control. Geopolitical concentration remains the ultimate physical choke point for the entire artificial intelligence economy. Every custom chip Broadcom designs relies entirely on advanced foundry packaging located in geopolitical vulnerability zones. As a leading demand indicator, this foundry data confirms that physical wafer allocation and advanced packaging pipelines are running at peak capacity. However, because these custom ASICs depend on CoWoS, any escalation in cross-strait geopolitical tension directly threatens Broadcom's physical supply chain continuity. Broadcom's custom chips require sub-5 nanometer process nodes that exist only within localized industrial ecosystems. While political pressure mounts in Washington to reshore semiconductor manufacturing, physical foundry buildouts require years of qualification. Broadcom leverages its co-design dominance to secure priority wafer allocations, effectively pricing out smaller competitors who lack the scale to command foundry line space. Beyond geography, public scrutiny is shifting rapidly from artificial intelligence software hype toward the massive energy consumption of modern data centers. Political leaders and local communities are actively challenging the power grid demands of gigawatt-scale infrastructure. This public backlash creates a massive structural tailwind for Broadcom. When power availability becomes the primary physical bottleneck, cloud operators must drastically reduce joules per token. Broadcom's custom silicon architectures and networking silicon deliver superior thermal efficiency compared to standard merchant chips. While Wall Street worries about capital expenditure fatigue, the physical realities of power grids and global supply chains ensure Broadcom remains the indispensable gatekeeper of AI infrastructure. Broadcom custom ASIC is trending higher at 421. Broadcom achieved record revenue, operating profit, and free cash flow in Q2 driven by accelerating growth in AI semiconductor revenue and strong operating leverage. Hock Tan, President and CEO, Q2 2026 earnings release. That was management's exact headline statement. It is engineered to focus investors entirely on top-line acceleration. Broadcom delivered $22,187 million in revenue for the second quarter, up 48% year-over-year. AI semiconductor revenue surged 143% to $10.8 billion. Third quarter revenue guidance was raised to approximately $29.4 billion. This narrative sells absolute growth and multi-year backlog visibility. It is designed to make you ignore missing per-share profit targets. It masks the structural execution risks behind those long-dated orders. Now look at the hard counter signals behind the corporate narrative. While management touted visibility extending clear into 2028, company insiders were cashing out. These sales were disclosed in mandatory Form 4 filings. When executives sell into record backlog claims, pay attention. Wall Street positioning reveals similar underlying friction. Yet, daily trading data showed ARKK trimmed 1,452 shares. ARKQ simultaneously trimmed another 568 shares. Short seller flow registered at 29.8% of daily volume. That remains well below the baseline of 39.1%, showing short sellers are not aggressively pressing. What management is saying is that demand is accelerating indefinitely. What the lab hears is that execution is getting far tighter than headline numbers suggest. To see where management shifted language, examine the Q2 earnings transcript. He asked why bookings were so high relative to immediate quarterly shipments. Hock Tan admitted the physical reality behind those customer commitments. Many are placing large orders now for future delivery, not immediate delivery, because they must align other elements like power and facility capacity. Hock Tan, President and CEO, Q2 2026 earnings call. That is a critical linguistic pivot. Management framed bookings as pure, unconstrained customer hardware appetite. Order visibility into 2028 was explicitly linked to external physical bottlenecks. Customers are locking in order slots early because utility power infrastructure is severely constrained. If hyperscaler facility build-outs stall due to power grid delays, those long-dated orders face deferral risk. Meanwhile, corporate spending reveals where Broadcom must continuously defend its moat. R&D reached $11.0 billion. That represents 17.2% of total revenue, growing 17.9% year-over-year. This heavy capital commitment is required to defend its custom ASIC layer. Hyperscalers are expanding internal design teams to eliminate third-party margin stack. Broadcom must keep spending aggressively to retain custom sockets against expanding internal customer engineering. Monitor the next 10Q for R&D spending and insider filing trends. Specifically watch whether R&D expense drops below 16% of revenue, while insider net sales remain above 500,000 shares per quarter. If R&D spend slows while executives keep selling, customer in-house design teams are displacing Broadcom's custom silicon partnerships. Set your calendar reminder for the next quarterly filing. The momentum breakdown for Broadcom. RSI sits at 72, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Broadcom's structural moat rests on two unmatched hardware anchors deep inside hyperscaler data centers. First is its dominance in custom XPU design partnerships, where deep co-packaged silicon integration locks hyperscalers into multi-year architectural commitments. Second is its high-bandwidth network switching architecture, led by the Tomahawk 5 and Jericho 3 X fabric switches that connect thousands of graphics chips across sprawling AI clusters. These physical networking choke points convert host infrastructure directly into Broadcom revenue streams, producing massive cash flow that validates their custom hardware lead over generic commodity silicon. This structural strength is why the stock trades at 65% of its annual range between $281.87 and $495, supported by technical indicators like an RSI of 72.3 and a bullish MACD crossover. However, this physical dominance faces immediate geopolitical and structural friction. Strict Bureau of Industry and Security export restrictions now directly target Broadcom's high-bandwidth Tomahawk 5 switches and custom AI XPUs destined for Chinese tech giants like ByteDance. Meanwhile, as hyperscalers expand internal design teams to eliminate vendor margin stack and Marvel ramps direct custom silicon competition, Broadcom's long-term socket retention is under active assault. Derivatives markets mirror this divided sentiment, with an options P/C ratio of 0.57 alongside a 25.7% drop in volume below its 20-day baseline. When semiconductor analysts sit down with management, one sharp question makes the room go quiet. Do those multi-year custom silicon order commitments represent absolute architectural lock-in? Or are hyperscalers over-ordering capacity simply to reserve scarce TSMC CoWoS packaging slots and utility power allocations ahead of real deployment? The lab's engineering reality check provides the definitive answer. Hyperscalers are indeed stacking orders early due to long lead times for wafers, memory, and facility power infrastructure. But this is not speculative double booking. The sheer complexity of co-designing physical interposers, thermal management systems, and high-speed SerDes interfaces binds these customers to Broadcom long before a single rack powers up. Once an ASIC architecture is taped out on 3 nanometers, migrating that workload to an in-house design or competing silicon takes up to 3 years of costly re-engineering. If Broadcom successfully converts its custom ASIC partnerships into sustained high-margin shipments while navigating TSMC packaging allocations, it proves that architectural switching costs completely insulate the business against in-house displacement. If tightening trade sanctions or customer internal silicon transitions cause order deferrals, it reveals that long-dated order backlogs were masking underlying facility power and deployment bottlenecks. Here's the macro picture shaping Broadcom. Strict USB export restrictions target Broadcom's high-bandwidth Tomahawk 5 switches and custom AI XPUs destined for Chinese tech giants like ByteDance. Furthermore, 100% reliance on TSMC for 3 nanometers foundry and CoWoS packaging leaves its custom silicon roadmap heavily exposed to Taiwan geopolitical risks. Exponential AI cluster growth is driving massive demand for Broadcom's custom ASIC accelerators alongside Jericho 3 X fabric switches connecting thousands of GPUs. At the lab, we see Broadcom operating at the absolute peak of the current AI infrastructure cycle. Management is aggressively framing lower gross margins as a benign product mix shift driven by massive XPU volume. pointing to multi-gigawatt agreements with Google, Meta, and OpenAI. But from an engineering standpoint, custom silicon naturally carries lower margin profiles than legacy infrastructure software, and trailing multiples above 70 times leave no margin for error. Over the next 2 quarters, top-line hypergrowth will continue, but gross margin compression will dictate whether this valuation peak holds. Broadcom outruns its peers on revenue growth, delivering a 47.9% surge versus the best-in-class 27.6% from Marvel. The lab sees Qualcomm lagging on every front, with a 1.2% price rise, 18.8 times P/E, and a 4% revenue decline. Marvel edges Broadcom on valuation, trading at 77.5 times P/E, while Broadcom lacks a disclosed multiple, suggesting the market may be pricing a narrative premium. Texas Instruments beats Broadcom on gross margin, posting 58% versus Qualcomm's 54% and Marvel's 52%, while still posting solid 22.8% growth. In the head-to-head, Qualcomm's only advantage is a modest 17% YTD gain, but its 4% revenue contraction and 54% margin leave it far behind AVGO's 47.9% growth. Marvel's advantage lies in a higher P/E multiple that reflects investor confidence in its 27.6% growth, yet its 52% margin trails TXN's durability. Texas Instruments dominates on margin and combines it with 22.8% growth, delivering the strongest operating durability among the three. Valuation check reveals AVGO's price of $421.47 dwarfs Qualcomm's $164.96, Marvel's $225.59, and Texas Instruments' $275.19. Yet without a disclosed P/E, the market cannot directly compare earnings multiples. The lab infers that the premium price assumes Broadcom will sustain its 47.9% growth, a rate far above Qualcomm's negative trend and Marvel's respectable climb. Capital efficiency hinges on the margin growth duo. TXN's 58% margin plus 22.8% growth outpaces Marvel's 52% margin and 27.6% growth, while Qualcomm's 54% margin is paired with shrinking revenue. AVGO's missing margin figure prevents a clean durability ranking, but its explosive growth suggests potential upside if margins align with peers. The market's willingness to pay $421.47 for a company with no disclosed P/E signals belief in a lasting AI-centric moat that outpaces the modest 1.2% price lift at Qualcomm and the 2.6% rise at Marvel. Yet the lack of transparent earnings multiples leaves investors guessing whether the price reflects real cash flow or speculative hype. The lab concludes Broadcom leads on top-line acceleration, but its moat will only hold if margin performance catches up to Texas Instruments' 58% benchmark, turning growth into sustainable profitability. Broadcom earned a strong high durability score of 76 in Teardown. What's the one number from Broadcom Teardown that surprised you most? Comment below. Please remember that all analysis here at Denver Stock Lab is strictly for educational-only purposes and is never financial advice. Always do your own thorough research before making investments, because past performance doesn't guarantee future results in any market environment. Subscribe so you don't miss Thursday's deep dive. We're tearing down Rocket Lab. If you want our full breakdown on NVIDIA, the link is in the description. Thanks for watching, and we'll see you soon.